Good morning. Welcome back. Short Vol Show Live. David Lincoln here, and I have a special guest today, Seth Golden. Welcome back to the program, Seth.
Hi. Well, thank you for having me again, David. It's an early morning, but happy to do the show. And we got some excitement in the market. I think the futures were up like 80 points before, and now looks like we're going to have a negative open. So something's going on we can talk about.
So is that because some sort of number just came out?
Yeah, it
Let's
looks like
see.
it's retail sales disappointed.
Okay.
Disappointed, depending on who you ask. Actually, Bank of America had a report out recently that pointed to the likely decline in month-to-month retail sales once the Census Bureau finally released them. We've been waiting on December's retail sales for a while now because of the government shutdown, and so today we finally get them, and they definitely did disappoint. The Census Bureau says, let me see here, retail sales sank 1.2% in December. It's the largest drop since September of 2009, a few months after the end of the Great Recession. Importantly, it's folks have to remember this is month to month. The headline number is month to month, so it's a 1.2% decline versus November 2018. And you typically will get that because November has Black Friday, of course. And it's even worse now because you don't just have Black Friday, you have Thanksgiving Thursday is open. So it makes the December comp that much tougher. But on a year-over-year basis, you still had, let me see, 2.3% increase in retail sales. So from December 2017 to December 2018, retail sales grew by 2.3%.
All right. Well, that sort of puts it in context. I know that the reporting at the time of like the holidays was that holiday sales were decent this year. I thought.
Yeah.
I thought that's what the reporting I saw was. Yeah, I was thinking of you before I came on. I was just looking at Drudge Report really quickly, and there was an article about brick and mortar stores once again disappearing. I know we've talked about that before as sort of Amazon has continued to dominate things. But it was talking about, it says another wave of store closings, and it was talking about, let's see, Gymboree and Charlotte Russe, 749 Gymboree stores closing, and 251 Shopko stores, and 94 Charlotte Russe, which I don't know what Charlotte Russe is, but that's been a theme for a while.
Store.
Okay.
Yeah. Like a small scale Forever 21.
Okay.
That kind of. We have one actually here in our small mall here in Ocala. But so far as that sentiment is concerned, like nothing's changed in the retail world. You have a horrible situation, and I want people to get the scope of it with that word, horrible. To the extent that retailers the retail stock prices kind of bounced back to some degree through much of 2018, but then really dropped off in the fourth quarter. And people started saying, oh, I thought, retail was dead as the retail stocks started to perform better. The reality is the only reason they were performing better for some of them is the year-over-year comps were just so easy, and the stocks had gotten so cheap on a relative basis. But the fundamentals did not change to support higher prices. Perfect examples are JCPenney, Macy's, Kohl's. I mean, these companies, when you look at their performances, through much of 2018 leading up to the fourth quarter, it's not like they deserved a 40% jump in share price off of maybe growing sales like 1 to 3%. No chance. And then came the fourth quarter, and Macy's pre-announced They pre-announced that they weren't going to make their guidance, and they lowered guidance. And that stock went from $17 to like $43 in 2018. And now it's all the way back to $24, $25. People are like, oh no, the market has it wrong. It's on discount again. They'll do better. There's no such thing as doing better as Macy's. There's just not. I mean, look at everything that JCPenney has tried to do. They've thrown everything possible at a brick and mortar, big box department store concept. Everything, including appliances, televisions, home flooring. I mean, they literally tried throwing everything into that store, from services to merchandise. Nothing has worked, to the same degree that they disappointed pretty much throughout the year. And now they're going to start closing stores again. And if you think Macy's has stopped closing stores, just be prepared for the announcement that in the near future that they're going to be looking at their store footprint again and possibly naming a specific number of stores they plan to close in 2019. They're right on the path. It's just a matter of they're ahead of, obviously, Sears, which is for all intents and purposes bankrupt,
right.
And JCPenney, which is just a step behind Sears. But Macy's is coming, they're coming into that time period where they're going to be the next JCPenney is the next Sears, Macy's is the next JCPenney, as well as Kohl's is the next JCPenney as well. The dynamic simply hasn't changed in how the consumer behaves. You're not going to be able to bridge this gap between online sales and physical store sales. It just can't be done. And if you haven't learned over the last decade that this is not something that you can change just by changing some of the assortment and collections inside of your store, then you're just expediting your path to becoming Sears and JCPenney. It's tough.
Yeah, it seems like the smart move for a lot of these people has been to actually just fundamentally change their business model to being sort of an online model, otherwise, perish. I think it's interesting what you were saying, how it's sort of like everything sold way off, and then it sort of kind of reverted back a little bit. But as usual, the market, it went overboard to the upside a little bit. And so it's like it went way down, and then it kind of snapped back. And now it's kind of finding a balance, but as you said, it's the writing's on the wall for a lot of these guys. What about your old alma mater, Target? Have you been sneaking around any Targets lately?
Yeah, I mean, and that's the differentiator. Like your survival landmarks in the retail industry are going to be those that service need-based goods or consumables. It's not going to be this type of department store where you can go and get discretionary goods. Why? Because the consumer doesn't spend on discretionary goods the way that they used to even a decade ago. But most importantly, from the time of the smartphone, which is about a decade now. Yeah, about a decade. People spend more on smartphones and media plans than they do on shoes, pants, and shirts. It's just a completely different dynamic than it was 10 years ago. And that's what a lot of people fail to understand. We will pay $1,000 for a phone and forsake a new pair of pants or a new pair of shoes. We will. We have been doing it for years. So just the dollars alone, when we look at retail sales, we look at where the dollars go, they just don't go to discretionary goods the way that they used to. Oh, yeah, well, smartphone's a discretionary good. No, I'm sorry. But if everybody on the planet is using a smartphone, that's a needs-based good. You don't have to like it, and you can say that we can do without them, and certainly we can. But the consumer dictates, and the consumer has said, my smartphone is something I have to have. So it's a needs-based good. So in terms of the consumables, that's food. We're talking about food. we have to have food. Those establishments, those retailers that provide food, they're hypermarkets, they provide everything from the home goods, clothing, to food. Those are the models, the retail models that'll likely be standing once this is over and done with. Your Kroger's, your Targets, your Walmarts. But the days of JCPenney, Sears, Macy's, Kohl's. We've seen so many other department stores go, by the way, and specialties, stores like Sports Authority, H.H. Gregg. Pier 1 Imports is on their last leg. I remember when Pier 1 Imports was trading in the $20 range. I think it's in the penny stock. It's in the dollar range now. Bon-Ton stores, they liquidated. Just those models are not going to work in this era.
Yeah, it's like, why go to Pier 1 Imports when you can go on Etsy and have a huge, more of a choice of things to get.
Right.
Pier 1 was a great idea at the time. These guys were like, all right, we'll go to like Bali and pick up all this cheap stuff and put it in the store, and people can put in their runs. But I was noticing, I work I have a side job in a gas station place, and it seems like it's Cumberland Farms, which is more of a local thing to New England here. But it seems like those places might be picking up some market share from other stores as well, because gas stations are no longer gas stations. Now they've got everything in the kitchen sink. If you go into the gas station, you can get, aspirin, or you can get car stuff, or you can get your food all in one spot, and that's got to be taking some market share away. The other thing I noticed with market share now recently is a lot of these big tech firms like Google, Amazon, IBM, Microsoft, a lot of their profitability now seems to be coming from the cloud and storing data on the cloud. I think it was something like IBM, a huge percentage now is just storing stuff on the cloud. Now, is that just like people on their phone want their data like off of their phone, so they just it's all in the cloud? Yeah, the margins are huge there, right?
Right. Yeah, the margins are huge, and you don't even know it's happening. It's just part of your plan, basically. You don't even know that it's happening, but that's where it's being stored. And the service providers, it's just implemented almost automatically, and you can ask for more storage, but it's not like your storage is limited to, the four corners of this smartphone platform. It's in the cloud, and you have a cloud provider that gets all these fees. And for them to store it is basically just having it exist, and possibly, and having firewalls and security parameters, which are also, an extremely low cost aspect of that business. But yeah, I mean, if it wasn't for AWS, Amazon, the story of Amazon as well as brick and mortar retail may not be what we see it has become over the recent years, because Amazon has basically been living off of those profits provided through AWS. If it was forced to limit itself because it didn't have that innovation and it didn't go down that revenue stream methodology, we may be looking at a different retail environment. We may not, Whole Foods may have never been acquired. That is probably something that, Amazon looks back on and goes, oh my God, how are we ever going to get out of this thing? But yeah, that whole business model, cloud computing, cloud storage, is just it's a great enterprise.
So let's talk about Amazon for a second. I know that many people have made a fortune buying Amazon. I talk to people, I bought it for $200, et cetera, et cetera. Do you think that it's possible that this stock is going to go to like, multiples of what it is now? Like, it's going to, go to $10,000, split 10 times, and keep moving higher at that kind of explosive rate? Or is Amazon in a range now?
It's easy for me to say, today, yes, it's going to go higher. It's infinitely, you can project multiples out and above where the valuation is today based on, I mean, just their sheer size and strength. They can just be a devouring force on the, in terms of mobile computing, data capture, analytics, AI, retail, you name it. It's just hard to imagine something impeding their progress based on where they are today. Having said that, I'm sure you could have said the same thing about IBM 20 years ago, right, or GE 20 years ago. So you never know for sure. And that's why you lean on leadership. That's why when you invest, there is a component of investing that is directly aimed at management and what you think of management's ability to navigate the future. So if you add that layer on to add that question, if you will, to the original question, I think you find yourself in a position where you can convincingly and self-assuredly say, yeah, there's really not much that can impede Amazon, and therefore the price to earnings trajectory should follow suit over time. So I think that a lot of people believe that, and that's why, when it dips the way it did in December, it got snapped up. It dipped under 1,400, rallied up to nearly 1,800. Yeah, that's a 400-point swing.
Yeah, I'm pulling up the chart right now. Yeah, let's talk for a second just about can you just sort of sum up the scenario of what has happened to the market since November? Yeah, and what was that, and what's gonna and how do you see things moving forward from here? I did check out some of your recent articles talking about levels and resistance, support, that sort of thing. But what happened to the market, and where are we now? I know that's kind of an open question, but if you could just sum it up quick, that would be interesting to me.
So Q4 was highlighted by a extremely overexuberant and poorly messaging FOMC headed by Chairman Powell. He basically stated that interest rate hikes were on autopilot. He made that statement at the September meeting, and then literally as the calendar kicked over into October, I think it was October 5th, the markets just started giving up the all-time high and did nothing but trend lower from that moment. Second part of that is it's the fourth quarter. Throughout the year, you had net outflows. So it's not like we were achieving these new all-time highs in the indices throughout the year with inflows. No, we had outflows all year long. So it served to figure that come the end of the year, and as markets started to give up the gains and turn negative, you were going to have redemptions on top of that. So now you have net outflows, you have redemptions in the November period, and you have this kind of a media cycle that was highlighting and fear mongering with regards to a global economic slowdown. You had the China fears, you had the trade war fears, and you had this looming deadline as well for the new year surrounding, are we going to increase tariffs or are we not? You put that all into this, soupy bowl, if you will, and it was just a really bad situation that also had compounding Fed messaging problems. So you had the original Fed messaging problem of autopilot on rate hikes, and then I think it was in December that you had the Fed, or maybe it was November that you had, we understand the market is not prepared, and maybe the economy is not prepared for more rate hikes, but so far as the balance sheet is concerned, we're okay with that. So it was literally like the second autopilot message from the Fed. And that just, took us that one leg lower in December. We just, we said, all right, we're done with this. The Fed just doesn't get it. And we took the final leg lower, and it induced a technical bear market. I think what we're seeing here in the new year is some of those fears were overblown. A lot of people thought that the Q4 results would mirror some of the rationale behind the selling pressure from the Q4 period, but that hasn't necessarily come to fruition. However, the forward-looking earnings estimates have also been brought way, way down. Now we're looking at 0 to maybe on the upper side 3% EPS growth for the bulk of 2019. So it's a fancy way, or it's a convoluted way in discussion of rationalizing the price to earnings multiple. Okay, so if we're going to have flat, let's call it flat. That's our baseline of earnings growth for 2019. If it's just going to be flat at 170 for the year on S&P 500 earnings, do we put a 15, a 16, or a 17 times multiple on that? Well, look, investors are automatically optimistic. Why invest if you think something's going to go down? So you're always thinking higher levels. Mm-hmm. And so that's somewhat of what we saw, or what we're, have seen throughout this New Year's rally, is the rationalization of the forward 12-month PE. Right now, people seem to think that 15.5 to 16 times earnings is the right multiple, given everything I just mentioned, or everything we just discussed regarding the Fed, geopolitical tensions, China-U.S. trade feud, government shutdowns, corporate earnings deceleration, and global economic slowdown. It's just a fancy way of rationalizing the price to earnings multiple.
It seems fairly reasonable historically, that sort of multiple, as we look back. So for retail traders who went through this experience of this sell-off and then rally. Now, I know I was saying to myself the whole time, like, redemptions have to, there has to be continued sellers coming in, continuing to sell this market. Redemptions have to continue. There has to be continued acceleration to the downside. Otherwise, we're going to turn around and come back up. And by saying that to myself, I was able to, put my finger on the trigger and buy into the sell-off a little bit, and not necessarily pick a bottom, but at least be sort of averaging in a little bit to be buying as things went lower there. How can retail traders figure this out in real time so that they can actually take advantage of that situation? What was your feeling at the time of that sell-off? Did you think we were going to follow through to the downside, or how can we figure this out in real time?
So, one of the things that I've learned over the last 20 years as an investor, as an analyst, as an economist, is it's extremely difficult and highly improbable to have a persisting bear market condition without a credit crisis and without the 10 to 2 yield, treasury yield inverting. It hasn't. It almost never happens. I think it's happened once, and that was in the 1990s. And we're talking about a bear market condition that only lasted for maybe a few months. So I'm sorry, where the 10s and 2s actually inverted was less than a month, and the market subsequently rallied. So you kind of have to have that basis of knowledge or experience, and that's why it tends to be a really good thing for your average trader person, retail trader, to have a service that they're involved with that can deliver them that kind of experience, the necessary, data points and research to coincide with how I should position in this environment. So throughout that whole time, those were the things that I was considering. Is the 10-2-year treasury inverted? No. And what that basically is, when we talk about the 10s and 2s inverting, we're talking about credit. We're talking about, are the banks lending? There's no reason for them to lend, when the yield curve is inverted. So That didn't happen. And we've had a flattening yield curve for a very long time. But to my point, there's no credit crisis. Okay, so you have credit flowing. It may not be flowing as expediently as it had in the past, but it's still flowing. And to the point of that whole Mnuchin calling up the banks thing, you remember that from Mexico, he called up the banks on vacation to see if they were having any liquidity issues, and they all were saying no. Why are you even calling us? That's pretty much what that was all about. It was a political stunt, if you will, to reassure markets that there's just nothing wrong with our the flow of credit, because without the seizure of the credit markets, it's just really hard to have a recession. So all those factor into why I believe that it was a technical bear market. Technical bear markets just don't last. And they get bought up quick, hard, and with force. So while all that was going on, it's uncomfortable. Nobody likes it. And yeah, if you participate in social media, you could easily get shaken out of the market and just basically take your losses and miss the potential rally. So we were trading. I run phenomgroup.com. That's my service. And all we really did was issue trade alerts on volatility day in, day out, and do extremely well. As we saw, the VIX itself went up to 36 in December. I think it peaked just over 36, like 36.03, 05 or whatever. You could probably pull it up. And that was it. The market was oversold. It had been oversold in oversold conditions for about 2 weeks. This is why I often say, the market is overbought. I've been saying that for over a week. The market's overbought. The market's overbought. I offer that in my research reports at phenomgroup.com every week. But for the last week and in my daily articles, I've been saying this market is overbought. But I also say, just like we were oversold, we can be overbought for longer than people think. We were oversold for 2 weeks. We've been overbought for about a week. So we may still be in overbought conditions for a little while longer. But make no mistake about it, we will not stay overbought. We will have a pullback. It's just a matter of when.
Yeah, I remember you saying before that as long as earnings growth drives everything, and as long as earnings are keeping moving forward, then we don't have too much to worry about. I know that everything just seemed to kind of become a perfect storm in December, and the political fears. I don't know if the shutdown was going on then yet, but all these things, we thought earnings was going to get revised down, and everybody was pretty afraid. And a lot of trading firms still are afraid and still think that the bear is going to come. Now, we know there's perma bears everywhere, and there always have been, but I think I saw some data that a lot of hedge funds had not taken advantage of this opportunity to actually buy the dip at all, and actually it had laid off buying the dip. And so it's kind of like hedge funds. A lot of hedge funds have done really badly because before the sell-off, a lot of them were just long the FANG, and then after the sell-off, they didn't buy the dip at all. And so, like, you'd think a hedge fund's supposed to, in my mind, is supposed to do something different than the regular market, not just buy the FANG and sit back. And I think a lot of these guys just leveraged, bought the FANG, got their heads ripped off, and then now they're gun shy and are cashing the side and miss the buyback, which, it comes back to, like, is it better just to buy the SPY and forget it than actually try to trade? It's been a rough going. All right. Well, let's move on to volatility and the VIX. It seems that a year ago, let's say a year and 3 months ago, there was a whole group of people that in our little StockTwits group who their whole trading strategy was surrounding the VIX ETPs, and like, you know, these guys were like, all right, you have your core short TVIX position, and then you kind of trade in and out of it, and that was their whole engagement with the market, was just trading, you know, TVIX and whatnot. We've learned in the last year that you got to have more arrows in your quiver than just that if you want to keep things going, because these VIX spikes and backwardation and stuff can last for a long enough time that you need to be doing something else to prosper in this market. And volatility now has gone back below 16. So is the short vol trade, are we back on? I know that contango has been probably averaged, I don't know, maybe 2% or more in the last month or so, which is
back in backwardation with today's move.
Yeah, well, and that's been happening a lot also, but at least we've come out of this huge period of backwardation. Is the short vol trade back on, or is it never going to come back to where it was a couple of years ago, as far as being a profitable day in day out type scenario?
So it's a loaded question, right? Because I tend to think of the short vol trade in my own framework of mind, which is, if you're of the opinion that markets trend higher, equity markets trend higher over time, then you're also of the opinion that volatility trends lower over time. The only caveats or inclusions are always going to be the macro environment. What is the Fed doing? Are they easing? Are they tightening? What are earnings doing? Are they growing? Are they accelerating? Are they decelerating? Are they negative? So there's a lot that goes into trading volatility that maybe some people haven't yet considered. But in terms of, is the short vol trade over? No, that is the trade. There are people that use volatility as a hedge, but that's not specifically trading volatility. They're out there buying SPX options, puts, if you will, and that just creates the dynamic in the volatility movement. But so far as going long VIX futures, buying VVIX options, call options, that's a trade with its limitations. And those limitations are that you are going against the natural order of volatility in the marketplace. Marketplaces don't exist in an ever appreciating volatile manner. Nobody would put their money into that set of circumstances. Markets like complacency, they like certainty, or at least a higher degree of certainty. You're never going to have exacts in the market or knowns in the market. There's always a layer of uncertainty, but the market likes higher degrees of certainty. And it can only function in that realm long term. There's no such thing as a market that exists like it did in the fourth quarter perpetually. Nobody's going to put their money in there. So in order to go long volatility for any duration of time, you're actually at the greatest risk. Just because you're long something doesn't necessarily mean has less risk than being short something, especially if being short that something, in this particular conversation, volatility is meant to decay over time, or at least the derivatives within the volatility complex are meant to decay. So if you're long, you're fighting that element. Mm-hmm. You actually have the larger amount of risk. But in tandem with that kind of definition is the risk that you have to manage if you're going to be short volatility or short the VIX ETPs. And as well as anybody, you've been doing this a while, it's about how much exposure. It is about understanding the macro environment and what's going on geopolitically, and where we are in the Fed cycle. It's been said that the Fed obliterates volatility. And to an extent, that's true, but it's only true in terms of psychology. It's not like there's some, when people, I love it when people on social media, on Twitter, they're like, oh, the Fed's shorting volatility. The Fed doesn't buy or sell VIX anything,
Right.
There's no magic lever or button whereby the Fed, pulls it down and says, okay, the VIX goes lower now, or pushes the button that says the VIX goes lower. No, it's a psychological thing that investors have just attuned themselves to believe that if the Fed is easing, there's a less chance of a recession ensuing, or the recession that we are in is going to be short-lived. And when they're tightening, as they have been over late 2017 and 2018, as they tighten, there's this belief that volatility will go higher, because what is the Fed trying to do by tightening? They're trying to decelerate economic activity, which tends to, in turn, decelerate earnings growth. Couple those two together and you have elevating volatility. That's the belief, but there's no mechanism whereby there's not a button, there's not a lever that all of a sudden gets pressed. It's just the belief of the investor community that, kind of pushes us out there in activity that depresses or increases volatility regimes. Volatility, in 2018, we had a higher volatility regime. In 2017, we had an extremely low volatility regime because we had a Fed that was pretty innocuous, coupled with the prospects of the first ever, tax reform coming into the picture since like the 80s. So those were just two big macro elements that served to suppress volatility in 2017.
Yeah, that makes sense. I mean, the Fed doesn't want, it's in the Fed's best interest to have lower volatility because they stay out of the headlines. People aren't, complaining about the stock market if it's not getting headlines of moving up or down all over the place every day. Because, volatility in the end is movement, around. Stuff's moving around. Stuff's rocking and rolling. We love it as traders, but, the government would much rather have us, rise 10% every year with no like outliers at all.
Yeah,
would be best for them. So are you advocating for I don't know, your clients and yourself? Are you maintaining like a short position in whatever your favorite ETP of the moment is now? Are you continuing to do that?
Yeah, I mean, but it's with a lot less exposure. Going back to what I said before, analyzing the macro environment that we're in helps me to decipher how much short volatility exposure I want to have in the market. And that's progressively gone down even since since the start of Q1. We were shorting TVIX in Q4 and even of late in Q1 of this year, and subsequently did extremely well because it's a 2 times levered instrument, and moves very quickly. I think it went all the way up to near $90, and within 40 days came all the way back down to $33. We literally shorted at every $10 price point on the way up and on the way back down. But after this huge rally that we had, we took down some of that exposure with regards to TVIX in preparation for basically what we believe would be a pullback in the market from overbought conditions. And the other instrument that we own in the short volatility world is VXXB, or the formerly known as VXX. So we own that, but again, that one has a much less exposure than I had in previous years. So still short volatility, if not for the fact that I believe that markets will go up over time. The volatility complex can also disassociate or deleverage if disconnect from the S&P 500, from time to time, and that's basically a reflection of expensive hedging. And when the VIX when it gets over 25, well, some may even say 20, but I say 25. The VIX gets to 25 and over, it becomes too expensive to hedge your portfolio. So it's at that point, and this is also what happened in the Q4 period, where you just saw just these flushes. The VIX didn't even move all that much for a couple of weeks because you just didn't have these hedge programs go on because the VIX was too expensive. It was too expensive to buy VVIX options. It's too expensive to buy S&P 500 options. So people said, we're just going to sell our equity positions and raise cash that way. There's just no reason to try and hedge with expensive hedges in a market that is doing nothing but go down. So you can have this disconnect, based on gamma alone.
So I'm sorry. So you're saying you're shorting VXXB, right? Is that right?
Yeah. And if it, yeah.
Okay, yeah, because you said we own it, but I think what you meant was we're shorting it. We're shorting it.
Yeah, we own it short.
Okay.
In our portfolio, it'll go up, it'll come down. We will trade around it. Short positional trading around that. But over time, it will eventually find a new low trading price. It's just a matter of when that happens. In between now and then, as it goes up, there's always intraday opportunities to short spikes, if you will. And that's what we deliver at phenomgroup.com as well. We have a private Twitter feed where we send out daily, weekly alerts shorting VXXB or UVXY or TVIX, as well as your regular equities that I'm associated with, retail stocks and the sort. But that's our way of basically not only generating profitable trades, but it also allows us to build liquidity in the account in the portfolio as your short positions are going against you or moving higher, if you will.
Yeah, we're definitely like in a totally different spot than we were a year ago.
Dow is down 200 points at the open on those retail sales numbers, and the VIX is up almost to 17, up $1.26.
Oh, I see. Yeah, I've been switching over to the charts as you've talked about various instruments and stuff. I keep switching over to the charts so people can see them sort of. It must look kind of strange from your end because I keep kind of looking over to the right here as I switch charts as you're talking. Yeah, it looks like a little sell-off. E-minis down 16 at this point. Dow down about 200. NASDAQ down 35 in the futures, looks like. And yeah, Dow futures down 145 right now. Yeah, and VIX, actually, it's not really in backwardation, but it's close to it. VIX 17, the front month future 1711. It's pretty flat, definitely. So yeah, we had the Vomageddon about a year ago. Things are I feel a lot different than I did then. That was a really frightening time period. There was a lot of people got really hurt in the Vomageddon, and there was a lot of us got criticized about that, saying that like we were advocating shorting volatility into that, and it was a tough time for all of us. Are things different? Has your model changed because of that Vomageddon, or how did that affect you specifically?
No, it was in November of 2017 that I had warned in a really extensive article that I published and distributed freely. I had warned folks about the danger of certain VIX exchange traded products, specifically XIV and SVXY. And I went into why those are the most dangerous instruments. But in kind with that, I was warning about, not against, but about shorting volatility. So with that framework, I also came into 2018, or I went into 2018 with a, much lesser exposure to the short volatility trade and with less leverage. In past years, UVXY, which was 2 times leveraged, was my instrument of choice. The decay was just extraordinary, and the environment was ripe for it. But I didn't believe that same setup was going to be available in 2018. So I went out of UVXY into VXX, 1 times leverage, moves far less than UVXY. And I had much less exposure. So going through Volmageddon, while, I took a drawdown just like anybody else does when they short volatility, it was only a matter of months. Before VXX it went to 55, it went all the way back down to 25. So in terms of, does it change your strategy? No, I was still shorting volatility from Volmageddon through over the next 6 months and taking profits along the way. So the strategy doesn't change. It's just a matter of, again, knowing the macro climate, and having the right exposure. But in no way, shape, or form can volatility stay elevated. It has no ability to do that. It's just up to you as the trader to know where and when and how much to position. That's what it comes down to.
Yeah, I was like sick to my stomach because I found, like, right after that Volmageddon thing, I found out that some of my viewers had these frankly outrageous positions where they were like long XIV and margined long XIV. Like their whole portfolio was just like margined extra long XIV and their savings and everything, and they had like quote unquote gone all in on that. And I wished, I did similar things where like I had a guy on talking about tail risk and XIV ahead of all that, and I had warned people about just the what the vol trade is about, but I had wished I'd done more because people, and I like to say that, and I'll just say it once again now. My long-term savings is not in tradable VIX stuff. I have the majority of my savings is in more conservative type things where, not betting the farm on the VIX trade at any one time. And I think people either they got really too excited about the VIX trade or they just didn't quite understand it. And I saw people that had these huge drawdowns where they'd bet everything on XIV or on some of the strategies that you and I outlined and just got utterly destroyed. And it's unfortunate because I think sometimes people, they find a video or they find a website and they hear a strategy and they focus in on that, and then they go all in on that one little strategy because that maybe they make a decent chunk of money in 1 month, and they say, well, if I can make $200 this month, let's do it. Let's do this, And people got destroyed, and so it's good to always mention that the volatility trade, when you're dealing with leveraged products, you want to like put less. That allows you to put less of your total percent in, not double up. Because if you just looked at like the StockTwits UVXY page, the volume was way down from then, and I don't even know if it's completely recovered since then. In my trading, like yours, has I have a lot less risk on now than I did back then, and fortunately, I was experienced enough to know that to have enough bullets, so the stuff does get to an extreme that I can sell more at the top, sell more as the volatility goes higher and higher and higher, as opposed to blowing out. But a lot of people didn't fare so well and really smarted from that time period, unfortunately.
Yeah, I mean, I often say, if you have success on that first trade, that's probably the worst thing that can happen to you, because you let that feed into your psyche and give you a false sense of security, with that particular strategy. So early success is not necessarily a good thing. I think long-term trading and investing demands of itself a struggle of some sort in the early going, whereby you course correct, you go back, you do some more due diligence, some more reading, research, and you develop over time, or you fine tune your strategies. So, always been of that opinion.
So do you think that there's a good chance that we will go back to a higher contango environment in the next year? I mean, things for in my mind, like if we continue to kind of rally, and if we possibly take out the highs, we could potentially get back into a 5 to 10% contango environment again, moving forward. Do you think that's possible, or structurally have things just changed?
No, I don't think. Well, if you consider a component of volume as structure, you could say certain things have changed, but using that as a variable in the equation, they've actually changed for the better, because you have less volume, you have less participation in VIX futures. So from that standpoint, there's a little bit of structural change. I think what we discussed about earlier is the Fed's involvement and what that does to psyche. So the Fed basically is on pause. They said as much. And when you look at Fed futures funds, there's no anticipated rate hike this year. None. Will the Fed live up to that? I believe so, as long as the data, which they've also reverted to the whole data dependency, MO, if that all comes to fruition, you have this prevailing sentiment that suggests the Fed put is in place. And in that type of environment, historically, you've had lower volatility regimes. Secondarily, if we just look at the year over year, right? We look at the volatility regime we went through in 2018, I think it would be hard to mirror that or have greater volatility this year. So
yeah, good point.
From those two vantage points, I think we actually will have less volatility in 2019. And there should be a period whereby we do tip over at least 5% term structure, or contango, as you say. We should find that at some point during the year, and it's more than likely going to come after an S&P 500 pullback from this rally point, and with the impetus from trade resolution. It's still one of the biggest overhangs of this market. And why? Because from a corporate level, you have the inflationary impact of goods, as well as the disintermediation of capital spending. So you have companies, they have no certainty on where the trade feud is going, and that forces them to be more conservative with their capital outlays. So if you can clear all that up with trade resolution, that doesn't mean a trade deal that everybody loves and makes everybody happy and it's all worked out. It just means a resolution whereby both parties can go to their separate corners, and say, we got something. That's all it takes. So,
I wanted to ask you a question about the shutdown. If they're talking a lot about how when we had the government shut down, government workers didn't get paid. And then there was also contractors that were subcontractors. Now, once they reopened the government workers got their back pay, but contractors didn't get their back pay. Now, is that something that could be seen as although it's obviously negative for the contractors, is that like a positive for the economy because the government's saving money? And also, does the shutdown, did that really hurt the U.S. economy like in a big way? Are we going to see repercussions like moving forward because of the shutdown, like in the future?
Uh, it's there's so many. There's going to be so many different opinions. But
Mm.
Seth, what I think yes, there is it's modest, but I do think there is a modest impact on the economy. But I think it's also something that kind of plays out in different arenas of the economy and over time. We've seen before from a government shutdown that the government thereafter finds it hard to replace employees. Like, people learn after they don't receive that check, because they live paycheck to paycheck, that this is not an institution that they want to go back to work for.
Right. Who
So
wants to
that's
work for
one,
free? Yeah.
yeah, I mean, that's one huge impairment to the government in and of itself. But then there's the chain of effect, like you said. Eventually, those government employees do get their back pay, but there's subcontractors out there that they're not entitled to that. There's no such thing as back pay.
Right.
They work off of a government contract. They're not going to need. It's kind of a funny narrative, because the media says one thing, which is government contractors won't get back pay, which is true, because the contract is duration. So they'll only be able to complete their project or their works that they're contracted to complete when the government reopens and then they start work again. So on the surface of the contract, they'll get the full payment of the contract. They're just delayed as to when the general contractor pays his or her employees.
Right. So they could have like started the new they're going to get paid for that contract, but they could have finished that contract earlier and been starting a new contract by now or something like that.
So it hurts sales, and it hurts retail sales during that time period. It hurts consumer spending during that time period. But everybody's made whole. It's just a matter of when.
So all right. So the left has floated. There's been a lot floated by the left politically about a tax on the ultra rich. I know AOC, as she's called, has floated this 70% tax on the rich, and I actually learned for the first time. I didn't actually know that tax rates in the U.S. between the 30s through the 50s were actually, for the highest income individuals, were up to 80 or 90% taxed here in the U.S. And I didn't know that. I thought that my knowledge was oh, well, somewhere in Sweden they tax people up to 70% and it stifles growth and nobody wants to work, because why should you work if the government's getting 90% of your money or something? But it turns out that here in the U.S. we used to have tax rates that were much higher on, once you made a certain amount, that additional amount you made was taxed higher. It wasn't 70% for your whole thing. But do you think that it's possible that a higher tax rate for the ultra rich could actually go through, and is that a good idea?
So regardless of who makes these, who initiates these types of referendums or policy initiatives, that's not terribly important to me. So on the surface of, these potential, tax initiatives, we go back to the 80s and 70s, 80s, 90s. Here's why I say there's zero possibility of what's being proposed happening. Zero. It's not possible. You do have to go back to that time period to understand why I say there's zero possibility. You can't have that type of tax rate and fewer shelters. Nobody paid that tax rate. None of the rich paid that tax rate back then. You remember there was this country called Panama? Do you remember this idea of Swiss bank accounts? Do you remember the notion of offshoring and tax shelters that were so abundant, government had no possible way of cracking down to the extent that it would actually, be a feasible action that would bring back tax revenues to the United States. It was just so prolific. It was ridiculous. And then there's also the drug trade, which was a means of laundering money for even the wealthy. So you don't have that. You don't have it to that extent anymore. You just don't have those same tax havens in Panama that you used to have, or Costa Rica that you used to have. And we all know about what has happened with the Swiss banking industry and those tax shelters, through the Obama administration era, and what they did to kind of rein that situation in. So today, you would have the more of an ability to enforce that tax level and have it actually be levied and followed by that, upper income bracket, and they're not going to have it. It's just not going to happen. It's all warm and fuzzy talk that everybody should pay their fair share. But when you get down to it, actually paying your fair share, most people don't have a stomach for. That's why these shelters have been created, and offshoring was created, and these safety accounts that you could not repatriate, you could not even look into, were created. But that is, it's so much curtailed nowadays that you just the two cannot coexist. You can't have less shelters and a higher tax rate. They can't coexist. It's just talking points, and it'll be talking points likely throughout the remainder of this election cycle. But coming to fruition, it proved me wrong. It proved me wrong.
Yeah, for me, I think, and I was reading an article actually before we came on this morning it was talking about how overall the government has accepted sorry.
I have my battery's going. I'm gonna have to plug this in. So give me 1 second.
Yep.
Be right back.
Okay.
And we're back.
All right.
Sorry about that.
Oh no, not at all. Yeah, I'm just pulling up an article that I saw this morning where it says that the government, overall the actual dollar amount of taxes that the government collected in 2018 was greater than the year before, which of course it should always be because there's more people alive, there's more, in America.
And the workforce exploded last year.
But the amount of taxes on corporations went down that they collected went down last year. It went down from 290, I think it's billion, to 195 billion. So to me, like an important thing for the government to do to help them to sort of balance the budget a little bit is to figure out ways to make the companies pay their fair share of taxes. So kind of close some of these loopholes where like Apple can say, oh, we're Apple Ireland or something, and we're going to put all of our money is going to go through this island, and therefore they don't end up paying, quote unquote, their fair share of taxes. A bunch of companies are doing that. And I know that people come on TV and say, well, that's just smart business. They should do whatever they can to make money for their customers. That's smart business. But, we need to, I feel like the government needs to, to make companies pay their fair share of taxes. And it's strange. It seems strange to me that companies would be paying way less this year in taxes than they were last year. And, the government needs that money to function. So I think that would be a little bit better politically thing to pass,
Yeah, but okay, let's speak for corporations. The more government, the more money we give to the government, what's going to happen to that money? They're going to spend it in ways that most citizens, most of the time, are like, what are you people doing? Like, you seriously need a limousine to and fro your house to the Capitol building? You seriously need that gold-plated XY, whatever? I mean, some of the spending that we see, and it doesn't matter what party is in office, some of the spending that we see, I'm trying to kind of curtail my fever here, but, and not say most of it. I'm trying to be fair and balanced here. But, that's how corporations view that whole dynamic, is they're just going to spend it frivolously. We're spending it to inject eventually back into the economy. And as has been proven over time, as our economy grows, as our society grows, as our technologies grow, what is the government doing with our taxes that we pay? Even the limited amount that we pay right now. So that's their angle. I'm not saying one is right and one is wrong. I'm just saying, there's different perspectives, and you can argue from for or against both sides. To the extent that I'm an investor, though, I have to admit, I believe that corporations have historically done more with the money than government. I have to. My main reason for saying that is I have no guarantee that I'm going to be able to collect Social Security. That in and of itself, when I turn 65, if even the age is 65 by that time, because the CBO says that by that time, so 20 plus years, there won't be a system whereby I can collect benefits. That is validation enough for me to say government doesn't know what to do with tax revenues. It's just, I can't live by that. I'd rather invest and know that, or believe that the company's trajectory, the history of the stock market, is validation that that's where the money is best, put.
What about the medical system here? Is there any hope on the horizon for it?
Go cannabis, right? I'm not, look, there's so many different systems around the world and how to handle healthcare. None of them are optimal. None of them. We complain about socialist types of healthcare run systems. We complain just as much with capitalistic, run healthcare systems like what we have in the United States. Where's the middle ground? Well, the middle ground, some would say, is the Danish version, or the certain areas of Europe, the Nordics, Sweden, Finland. They tend to have systems that work for them and have continued to work for them decades and decades and decades. But the problem is the disparity in population. It's okay to have that type of system with minimal population. Can you scale it to that of United States? 400 plus million people. It's improbable. So, but nonetheless, okay. So at some point here, it kind of circles around to the conversation of how does the government fix this? Is it more, taxing more, on companies so that, they can develop more programs to assist the healthcare needs of the average citizen? Well, it's a great thought. How do we put it into practice? Bottom line is, look, there's a lot of reasons why people don't like America or Americans, and it comes down to our capitalistic nature. And we have this ability, or this hinderment that other countries, when they look at us, say of, not dealing with problems until they are a crisis, like 2008. We just tend to let things go too far, too long. We build bubbles, they say, right? We build these bubbles, and until the bubble bursts, we don't do anything about it. But when it bursts, then you get legislation. Then you get reform. Then you get pain. That was 2007, 8, 9, right? So I'm of the opinion, make it very short and sweet, we will not do anything. We will not fix anything until there's a crisis in in America when it comes to healthcare. We just won't. We might put Band-Aids on here and there, but we're not going to fix it. And therefore, medical costs will always increase. And we'll find ourselves in a place where because that is the highest cost for the government. It is healthcare. It is Medicare. It is Medicaid. That's where all the debt it's not all of it. It's the majority of the debt comes from there. And it will continue to do so until it eventually puts us in a state where we can't repay our debt. We can't pay the treasury issuances that we have been, throwing at the global world, global debt market for the last 30 years.
Yeah, that makes sense. All right, so I'm running out of time, but I want to just ask you for some, maybe I asked this to a lot of people, but where would you invest $1,000 right now, and what sort of stock picks do you have just to keep in to maybe add someone to add to their watch list that they might not be watching right now? What are you looking at as far as like stuff to get long?
I'm looking at consumer staples right now, mainly because there is a lot of uncertainty out there. So I am, looking at, your Verizons of the world, which have, these lofty dividends, 5-6%, and flat earnings, flat revenue, but it's just such a stable business to get that 5-6% dividend annually. My downside risk is extremely limited. But my upside potential with 5G coming is pretty healthy, So I kind of like the consumer staples, your Johnson & Johnson stocks. In this environment where we're not quite sure of what earnings are going to look like in 2019, those could be some good ideas. You say investing, and I understand that, but for the time being, there is some element of capital preservation that is pervading the marketplace right now. We still have net outflows this year. Even though the market has been round, we're up like 16% on the S&P 500 from the bottom. We've had net outflows this year. So there's still this, and look at the US dollar. The US dollar is back above 97. So there's still this fear in the market. There is still this fear. So there's that element that you have to appreciate of capital preservation. But longer term, even though might be preserving some capital by going the consumer staples route, there's still the opportunity for growth there. Plus, I get a dividend. So yeah, it's kind of grandpa's way of investing, but that's okay from time to time.
Yeah, I like the dividend ideas. I've been looking at some of those too, and I like J&J. I was definitely watching that. I also like ConocoPhillips as a similar thing, like a pipeline type company.
Yeah.
Great. All right. Well, listen, it's been great to catch up with you a little bit, and I know,
you too, Dave.
I don't know when was the last time you came on, but it was a while back.
It's been a while, yeah.
But check. Still the only site that I actually pay to get financial information is phenomgroup.com. There will be links in the description. Your articles are awesome. Great. Macro information and also levels on the major indices. So check out Seth's articles at phenomgroup.com. And I would say people should also subscribe to your Twitter, which I will also put links in the description because you have some interesting alerts and updates on that. I saw you in a Bloomberg article a couple weeks ago with Luke Kawa, I believe his name is.
Yeah, they featured some of my Luke interviewed me for some comments on, the Volmageddon. How did I feel going through that, and what do I say to people, with that and memory and whatnot. So yeah, some of my comments were featured in there, and I think the prevailing sentiment was know what you invest in, know what you're trading, know what you invest in. And
I've seen you on Thinkorswim TV a couple times.
Yep.
So catch Seth out in the environment. Thank you once again for all your support of me and this channel. And you were, as I was explaining to someone a couple days ago, probably like the first person who anybody knows about who followed me on Twitter, and you've always supported me and the channel. So that's definitely it was a huge huge help in the beginning, and is still much appreciated now.
100%.
Nice to talk to you. Stay with me once we go offline here, and thanks Seth for coming on, and thanks everybody for watching. We'll see you next time on the Short Vol Show live.
Like 4 to